The components and practices of insurance claims management. The Solomon Fadun, Risk Management of Everything channel, presents the components and practices of insurance claims management. Welcome to the Solomon Fadun, Risk Management of Everything channel. On this channel, you will see videos on risk management and its application to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to be notified when we upload new videos. Thank you. This video discusses the components and practices of insurance claims management. The video will help you to understand the insurance contract, insurance claims settlement, the relationship between the insurance contract and claims settlement, types of claims settlement, factors affecting insurance claims settlement, effects of the principles of insurance on claims management, challenges in insurance claims settlement, types of insurance claims management, life and non-life insurance claims process, the major differences between life and non-life insurance claims processes. Claims documentation by the insured and the insurer, challenges in claims documentation, importance of accurate documentation in claims settlement, customer service in claims management, the importance of customer service in claims management, objectives of customer service in claims management, components of customer service in claims management, customer service at different stages of claims management, customer complaints handling in claims management, challenges of customer service in insurance claims management, the best practices in customer service for claims management, and the role of claims personnel in customer service. Now, let's begin. Introduction. Insurance claims management is one of the most critical functions in the insurance industry. It represents the process through which insurers investigate, evaluate, process, and settle claims made by policyholders after insured losses occur. Effective claims management ensures fairness, policy compliance, customer satisfaction, fraud prevention, operational efficiency, and financial stability for insurance companies. Claims management serves as the practical demonstration of the insurance promise. While underwriting focuses on risk acceptance and premium collection, claims management determines whether the insurer fulfills contractual obligations. A well-managed claims process enhances customer trust and strengthens insurers' reputations. This video explores the major components and practices of insurance claims management, including factors affecting claims settlement, insurance principles, pre-loss and post-loss management, claims processes in life and non-life insurance, reinsurance claims, and claims department administration. The insurance contract. An insurance contract is a legally binding agreement between an insurer and an insured under which the insurer agrees to provide financial compensation or specified benefits upon the occurrence of insured events, in exchange for the insured's payment of premiums. The contract outlines the scope of coverage, the obligations of both parties, the conditions of insurance, the exclusions, the claims procedures, and the methods of compensation. Insurance contracts may relate to life, motor, fire, marine, aviation, engineering, liability, health, and other classes of insurance business. Insurance claims settlement is one of the most important functions performed by insurance companies. It represents the practical fulfillment of the insurer's contractual promise to compensate policyholders or beneficiaries after the occurrence of insured events. The efficiency, fairness, and accuracy of claims settlement significantly influence customer satisfaction, insurer reputation, profitability, and regulatory compliance. The insurance contract is the legal foundation for claims settlement. Claims are assessed according to the terms, conditions, exclusions, warranties, endorsements, and clauses contained in the policy document. The insurer's liability depends entirely on what was agreed between both parties at policy inception. Insurance contracts are contracts of utmost good faith, meaning that both the insurer and the insured must act honestly and disclose all material facts. Since the policy document defines the rights and obligations of both parties, claims settlement cannot exceed the contract's terms. Nature of the insurance contract. 1. Contract of utmost good faith. Insurance contracts are contracts of utmost good faith, also known as uberrimi fidei. Both parties are expected to disclose all material facts honestly and completely. The insured must provide accurate information regarding the risk being insured, while the insurer must explain policy terms clearly and fairly. Failure to disclose material information may affect claims settlement and may result in the repudiation of claims. 2. Contract of indemnity. Most non-life insurance contracts operate on the principle of indemnity. The insurer compensates the insured only to the extent of actual financial loss suffered. The objective is to restore the insured to the same financial position as before the loss, without allowing a profit from the insurance. Life insurance differs because it generally provides predetermined benefits rather than indemnity-based compensation. 3. Aleatory contract. Insurance contracts are aleatory because the amounts paid by the parties are unequal and depend on uncertain future events. The insured pays a relatively small premium, while the insurer may become liable for substantial compensation if a loss occurs. 4. Contract of adhesion. Insurance contracts are generally prepared by insurers, leaving policyholders with limited ability to negotiate terms. The insured usually accepts or rejects the contract as presented. Because insurers draft policy wordings, courts often interpret ambiguous terms against the insurer in disputes. 5. Personal contract. Insurance contracts are personal agreements between the insurer and the insured. The insurer evaluates the character, financial status, health condition, or risk profile of the insured before issuing coverage. The contract, therefore, applies specifically to the insured person or entity. Insurance claims settlement. Insurance claims settlement is the process by which insurers compensate policyholders or beneficiaries after confirming that losses are covered under the policy. Claims settlement involves investigation, assessment, documentation review, liability determination, negotiation, and payment of compensation. Settlement represents the fulfillment of the insurer's contractual obligation under the insurance policy. Claims settlement represents the practical fulfillment of the insurer's promise under the insurance contract. Every claim is evaluated according to policy terms, insurance principles, documentation requirements, and legal standards. The effectiveness of claims settlement depends on proper contract interpretation, compliance with policy conditions, accurate investigations, fair assessment procedures, and efficient customer service. Efficient insurance claims settlement promotes customer satisfaction, protects insurer solvency, enhances public confidence, and supports the long-term sustainability of the insurance industry. Relationship between the insurance contract and claims settlement. 1. Policy terms determine claims liability. Claims settlement depends entirely on the terms and conditions contained in the insurance contract. The insurer examines whether the loss falls within insured perils and whether the insured complied with policy conditions. Coverage limitations, deductibles, warranties, exclusions, and endorsements directly affect settlement decisions. 2. Insurance principles guide settlement decisions. Insurance principles embedded within the contract influence claims settlement procedures. Principles such as utmost good faith, indemnity, proximate cause, subrogation, contribution, and insurable interest determine liability and compensation. 3. Contractual obligations affect settlement rights. Both insurer and insured have contractual obligations that affect claims settlement. The insured must pay premiums, disclose material facts, promptly notify of losses, submit required documentation, and cooperate during investigations. The insurer must investigate claims fairly, communicate clearly, settle valid claims promptly, and comply with policy terms. Failure by either party to fulfill its obligations may affect the outcome of claims. Types of claims settlement. These are the core types of claims settlement. 1. Cash settlement. The insurer pays monetary compensation directly to the insured. 2. Repair settlement. The insurer arranges repairs through approved service providers. 3. Replacement settlement. Damaged or lost property is replaced with equivalent items. 4. Reinstatement. Property is restored to its pre-loss condition. 5. Benefit payment in life insurance. Life insurance claims are settled through payment of agreed sums assured, bonuses, surrender values, or annuity benefits. Factors affecting insurance claims settlement. Claims settlement is not automatic upon the occurrence of loss. Several legal, contractual, financial, operational, and behavioral factors determine whether a claim will be accepted, rejected, reduced, delayed, or fully settled. These factors guide insurers in determining liability, measuring the extent of loss, and ensuring that compensation aligns with policy provisions and insurance principles. Understanding the factors affecting insurance claims settlement is essential for insurers, policyholders, brokers, risk managers, claims professionals, and regulators. The factors influencing insurance claims settlement include: 1. Insurance policy conditions. Insurance policies contain several conditions that policyholders must comply with before claims become payable. Failure to comply with policy conditions may result in the repudiation or reduction of claims. One major condition is prompt notification of loss. Most policies require the insured to report losses immediately or within a specified time frame. Delayed reporting may hinder investigations and affect the insurer's ability to verify the loss. Another important condition is the submission of proof of loss. Policyholders are expected to provide evidence supporting the occurrence and extent of damages. Such evidence may include invoices, receipts, police reports, medical records, repair estimates, photographs, or witness statements. Policies may also contain warranties requiring the insured to maintain certain safety measures. For example, a fire insurance policy may require the installation of fire extinguishers, while burglary insurance may require approved security systems. Breach of warranties can invalidate claims. Exclusions within policies also affect claims settlement. Losses arising from excluded events are not compensable. Common exclusions include war risks, wear and tear, gradual deterioration, intentional acts, and nuclear hazards. 2. Payment of premium. Premium payment is a fundamental requirement for insurance coverage. Insurance contracts are based on consideration, meaning that the insurer provides protection in exchange for a premium payment. If premiums are unpaid at the time of loss, the insurer may deny liability depending on policy provisions and applicable insurance laws. Some jurisdictions permit grace periods, while others require strict premium payment before coverage attaches. The mode and timing of premium payment, therefore, influence claims settlement. Policies that have lapsed due to non-payment generally do not provide valid claims protection. 3. Disclosure of material facts. The principle of utmost good faith, also known as uberrimi fidei, requires both parties to disclose all material facts honestly and accurately. Material facts are facts capable of influencing the insurer's decision regarding acceptance of risk, premium rating, or policy terms. During claims settlement, insurers often investigate whether the insured disclosed all relevant information at policy inception. Non-disclosure or misrepresentation can lead to the repudiation of a claim. For example, Failure to disclose previous illnesses in life insurance or prior accidents in motor insurance may invalidate claims. Fraudulent concealment of material information is considered a serious breach of insurance contracts and significantly affects claims settlement outcomes. 4. Existence of financial interest. The insured must possess insurable interest in the subject matter of insurance. Insurable interest means that the insured stands to suffer financial loss if the insured event occurs. Claims settlement depends on proof of insurable interest. A person cannot recover under an insurance policy if no legitimate financial or legal interest exists in the insured property or life. For example, a person cannot claim compensation for damage to another person's property unless there is a recognized legal or financial relationship. In life insurance, insurable interest generally exists between spouses, business partners, creditors, and family members. 5. Prevention of financial gain from insurance. Most non-life insurance contracts operate on the principle of indemnity. The purpose is to restore the insured to the same financial position as before the loss, without allowing a profit from the insurance. Claims settlement is therefore limited to the actual financial loss suffered. The insurer assesses the value of damaged or lost property and compensates accordingly. Several methods may be used in applying indemnity during claims settlement. These include market value basis, replacement cost basis, reinstatement basis, and agreed value basis. Depreciation also affects indemnity. Older assets may receive lower compensation due to wear and tear or diminished market value. 6. Determination of the effective cause of loss. The principle of proximate cause determines whether a claim falls within policy coverage. Proximate cause refers to the dominant, effective, and nearest cause responsible for the loss. Claims settlement depends on whether the proximate cause is an insured peril or an excluded peril. If the dominant cause of loss is insured under the policy, the claim becomes payable. Conversely, if the proximate cause is excluded, the insurer may reject the claim. This principle becomes particularly important where losses result from multiple interconnected events. 7. Duty of the insured to reduce loss. The insured has a responsibility to take reasonable steps to prevent or minimize losses after the occurrence of insured events. Insurance does not encourage negligence. Policyholders are expected to protect insured property from further damage. Failure to do so may reduce claims payable. For instance, after a fire outbreak, the insured is expected to salvage undamaged property where possible. Similarly, after motor accidents, policyholders should take steps to prevent additional damage to vehicles. Insurers consider the insured's actions during claims assessment. 8. Adequacy of documentation. Claims settlement depends heavily on the availability and accuracy of supporting documents. Proper documentation enables insurers to verify losses, establish liability, and quantify damages. The type of required documentation varies according to the class of insurance involved. Motor insurance may require police reports, vehicle particulars, repair estimates, and driver's licenses. Fire insurance may require fire service reports, inventory lists, and photographs. Marine insurance claims may require bills of lading, invoices, and survey reports. Incomplete or inaccurate documentation can delay settlement or lead to disputes between insurers and claimants. 9. Investigation and loss assessment. Insurance companies conduct investigations to verify the authenticity of claims and determine liability. Claims investigation helps insurers identify fraudulent claims, confirm policy coverage, and evaluate the extent of damages. Investigations may involve site inspections, interviews, forensic analysis, expert consultation, and review of supporting evidence. Claims adjusters, surveyors, engineers, medical practitioners, legal experts, and forensic investigators may participate in the process, depending on the claim's complexity. The quality and outcome of investigations significantly affect claims settlement decisions. 10. Claims. Insurance fraud is one of the major factors affecting claims settlement worldwide. Fraudulent claims involve deliberate attempts to obtain unlawful financial benefits from insurers. Examples include staged accidents, inflated losses, forged documents, false death claims, arson, and duplicate claims. Fraud increases claims costs, affects insurer profitability, and leads to higher insurance premiums. Consequently, insurers implement strict verification and anti-fraud procedures before settling claims. Where fraud is detected, insurers may reject claims entirely and pursue legal action against offenders. 11. Underinsurance and average clause. Underinsurance occurs when the sum insured is lower than the actual value of the insured property. In such situations, insurers apply the average clause when settling claims. The average clause requires the insured to bear a proportion of the loss corresponding to the level of underinsurance. For example, if a property valued at $100 million is insured for $50 million, the property is underinsured, and the insurer will pay only 50% in the event of a partial loss. Underinsurance, therefore, reduces the amount payable during claims settlement. 12. Reinsurance arrangements. Insurance companies often transfer portions of risk to reinsurers. Reinsurance arrangements help insurers manage large or catastrophic losses. In major claims situations, the insurer may need to recover part of the claims amount from reinsurers before completing settlement. Delays in reinsurance recoveries may affect the speed of claims payment. Complex treaty conditions and international reinsurance arrangements can also influence claims administration. 13. Legal and regulatory environment. Insurance operations are regulated by laws, supervisory authorities, and industry guidelines. Regulatory frameworks establish standards for fair claims handling, complaint resolution, solvency, and consumer protection. Regulators may impose timelines for claims settlement and penalties for unfair claims practices. Court judgments and legal interpretations also influence how insurers handle claims. Litigation may arise where disputes occur regarding policy interpretation, liability, or settlement amounts. The legal environment, therefore, plays an important role in claims settlement procedures. 14. Economic conditions and inflation. Economic conditions significantly affect insurance claims costs. Inflation increases the cost of repairs, medical treatment, replacement materials, and labor. Currency fluctuations may also affect claims involving imported goods or international transactions. During periods of economic instability, insurers may experience increased claims severity and reserving challenges. Economic conditions, therefore, influence claims valuation and the adequacy of settlements. 15. Technological factors. Technology has transformed insurance claims management. Modern insurers use digital platforms, artificial intelligence, automation, and data analytics to improve the efficiency of claims processing. Electronic claims submission, online documentation, mobile applications, and automated workflows reduce delays and enhance customer experience. Technology also supports fraud detection, data security, claims tracking, and customer communication. However, cybersecurity threats and system failures may negatively affect claims operations. 16. Human factors and professional competence. The competence and integrity of claims personnel significantly affect settlement quality. Claims officers, adjusters, investigators, and legal professionals require technical expertise, analytical ability, negotiation skills, and ethical standards. Poorly trained staff may mishandle claims, create delays, or make inaccurate settlement decisions. Professionalism, experience, and effective communication are therefore essential for efficient claims settlement. 17. Customer behavior and cooperation. Claims settlement is smoother when policyholders cooperate with insurers during investigations and documentation processes. Lack of cooperation, delayed responses, concealment of information, or hostile behavior may complicate claims handling. Policyholders who understand policy conditions and claims procedures generally experience faster settlement outcomes. Customer awareness and communication, therefore, influence the efficiency of claims administration. Consequently, insurance claims settlement is influenced by multiple interconnected factors involving legal obligations, contractual terms, insurance principles, operational procedures, economic conditions, technology, and human behavior. Factors such as policy conditions, premium payment, utmost good faith, indemnity, proximate cause, documentation, fraud, investigations under insurance, reinsurance, regulation, inflation, and customer cooperation play vital roles in determining whether claims are settled promptly and fairly. Furthermore, efficient claims settlement requires transparency, professionalism, compliance with policy provisions, effective investigation systems, and strong customer service practices. For insurance companies, effective claims management enhances operational efficiency, financial stability, customer trust, and long-term sustainability. Effects of the principles of insurance on claims management. The principles of insurance form the legal and operational foundation upon which insurance business is conducted. These principles guide insurers, policyholders, brokers, and claims professionals in the administration and settlement of insurance claims. They ensure fairness, consistency, transparency, and financial discipline within the insurance system. Claims management is influenced by these principles because insurance claims cannot be assessed or settled outside the framework of insurance law and contractual obligations. The principles determine the validity of claims, the extent of insurer liability, the responsibilities of policyholders, and the procedures used during claims investigation and settlement. Understanding the effects of insurance principles on claims management is essential for efficient claims administration, fraud prevention, dispute resolution, and maintenance of insurer solvency. 1. The principle of utmost good faith. The principle of utmost good faith, also known as uberrimi fidei, requires both the insurer and the insured to disclose all material facts honestly and completely before and during the insurance contract. Material facts are information capable of influencing the insurer's decision regarding risk acceptance, premium determination, policy terms, or coverage conditions. Insurance contracts rely heavily on trust because insurers often accept risks based on information provided by policyholders. One of the major effects of utmost good faith on claims management is the investigation of disclosures made at policy inception. During claims processing, insurers examine proposal forms, declarations, medical reports, financial statements, and other records to confirm whether all material facts were properly disclosed. Where the insured concealed or misrepresented material information, the insurer may reject the claim or avoid the policy entirely. For example, in life insurance, failure to disclose serious medical conditions may affect the settlement of claims after death. In motor insurance, concealment of prior accidents or improper vehicle usage may invalidate claims. The principle of utmost good faith promotes honesty and discourages fraud. Claims managers rely on truthful information from policyholders during loss reporting and documentation. Where fraudulent statements or forged documents are discovered, insurers may repudiate claims and initiate legal action. Claims departments, therefore, conduct extensive investigations to verify the accuracy of information submitted by claimants. Utmost good faith strengthens confidence in insurance transactions. Efficient claims settlement becomes possible when insurers trust the information provided by policyholders and when insured persons believe insurers will act fairly. This principle, therefore, improves cooperation during claims handling. 2. The principle of insurable interest. Insurable interest exists when a person stands to suffer financial loss or legal liability from damage to the insured subject matter. Without insurable interest, an insurance contract becomes invalid because insurance is designed to protect legitimate financial interests rather than provide speculative gains. Claims managers must confirm the existence of insurable interest before settling claims. A claimant cannot recover under an insurance policy unless there is proof of legal or financial interest in the insured property, life, or liability. For example, a person cannot claim compensation for a building owned entirely by another person unless there is a recognized legal relationship such as tenancy, mortgage interest, or partnership. In life insurance, insurable interest must generally exist at policy inception. Insurers verify relationships between policyholders and insured persons during claims assessment. The principle of insurable interest prevents insurance from becoming a gambling or speculative activity. Claims management systems, therefore, ensure that only persons with legitimate interests receive compensation. This reduces moral hazard and fraudulent attempts to profit from losses. Clear proof of insurable interest helps reduce disputes during claims settlement. Ownership documents, invoices, loan agreements, and legal contracts often serve as evidence supporting claims. Claims managers rely on such documentation to determine entitlement to compensation. 3. The principle of indemnity states that insurance compensation should restore the insured to the same financial position as before the loss, without allowing a profit from the insurance. Most non-life insurance contracts operate under this principle. The principle of indemnity directly influences how claims are valued and settled. Claims managers assess the actual financial loss suffered by the insured and ensure that compensation does not exceed that amount. The insurer may compensate based on market value, replacement cost, reinstatement value, or agreed value, depending on policy terms. Depreciation, wear and tear, salvage value, and policy excesses are often considered during settlement calculations. Indemnity prevents policyholders from profiting from losses. Claims management, therefore, focuses on restoring financial position rather than creating financial gain. For example, if a damaged asset has depreciated over time, compensation may reflect its current market value rather than its original purchase price. This principle ensures fairness and financial discipline in claims administration. Claims investigators carefully evaluate the extent of damages to avoid overpayment. Independent adjusters, engineers, valuers, and surveyors may be engaged to assess losses objectively. The principle, therefore, promotes accurate claims assessment and cost control. Indemnity also influences the application of the average clause in cases of underinsurance. Where the sum insured is less than the actual value of the property, the insured becomes a co-insurer for the uninsured portion of the risk. Claims settlement is therefore reduced proportionally. 4. The principle of subrogation. Subrogation is the legal right of an insurer to recover from third parties responsible for losses after compensating the insured. The insurer steps into the insured's position to pursue recovery against negligent parties. Subrogation helps insurers recover amounts paid on claims from responsible third parties. This reduces overall claims costs and protects insurer profitability. For example, after paying a motor accident claim, the insurer may recover the amount paid from the negligent driver. Effective subrogation reduces insurers' financial losses and lowers claims expenses. This may help stabilize premium rates for policyholders. Claims departments, therefore, maintain recovery units responsible for pursuing subrogation actions. Subrogation prevents the insured from receiving compensation twice for the same loss. Once the insurer indemnifies the policyholder, the right to recover from third parties transfers to the insurer. Claims managers ensure that policyholders do not obtain duplicate recoveries from both insurers and negligent parties. Claims management processes often require collecting evidence necessary for subrogation actions. Police reports, witness statements, repair estimates, and legal records become important during recovery proceedings. The principle, therefore, affects documentation and investigation procedures. 5. The principle of contribution. The principle of contribution applies where the same risk is insured by multiple insurers. Each insurer contributes proportionally to the loss according to the extent of coverage provided. Contribution prevents overcompensation of the insured. Claims managers coordinate with other insurers where double insurance exists. The loss is shared proportionally based on policy limits and contractual arrangements. For example, if two insurers insure a factory, both insurers contribute to the rateable proportion of the claim settlement. Contribution prevents policyholders from recovering the full amount of loss from multiple insurers separately. Claims departments, therefore, investigate whether other insurance policies exist before completing settlement. The principle encourages collaboration between insurers during claims settlement. Insurers exchange information, adjust liability proportions, and coordinate payment responsibilities. This enhances efficiency and reduces disputes among insurers. 6. The principle of proximate cause. Proximate cause refers to the dominant, effective, and nearest cause responsible for a loss. Claims settlement depends on whether the proximate cause falls within insured perils under the policy. Claims managers investigate the actual cause of loss before approving claims. If the proximate cause is covered by the policy, the claim becomes payable. If the dominant cause is excluded, the insurer may reject the claim. For example, a fire insurance policy may cover fire damage but exclude war-related destruction. If war causes the fire, the claim may not be payable. The principle often requires technical investigations where multiple events contribute to losses. Claims adjusters, engineers, forensic experts, and legal professionals may participate in determining proximate cause. Complex causation issues are common in marine, engineering, aviation, and liability insurance claims. Clear determination of the proximate cause helps resolve disputes between insurers and policyholders. Claims decisions become more consistent and legally defensible. 7. The principle of loss minimization. The insured has a duty to take reasonable steps to prevent or reduce losses after the occurrence of insured events. Insurance is designed to compensate accidental losses, not encourage negligence. Claims management encourages policyholders to act responsibly during emergencies. Prompt actions by insured persons may significantly reduce the extent of damage. For example, after a water leak, immediate repairs may prevent further property damage. Claims managers evaluate whether the insured acted reasonably after the loss occurred. Failure to minimize damages may reduce compensation payable. The insurer may reject portions of losses resulting from negligence or avoidable deterioration after the insured event. The principle encourages proactive risk management among policyholders. Insurers often provide safety recommendations, emergency response guidelines, and loss prevention advice. This reduces claims frequency and improves overall insurance performance. 8. The principle of cause and effect in fraud detection. Insurance principles collectively support fraud detection and ethical claims handling. Claims management systems rely on principles such as utmost good faith, indemnity, insurable interest, and proximate cause to identify suspicious patterns and inconsistencies in claims. These principles help insurers establish verification procedures, investigation standards, and legal defenses against fraudulent claims. This promotes fairness and equity. Insurance principles ensure that claims settlement is fair to both insurers and policyholders. They prevent abuse while protecting legitimate claimants. Claims managers use insurance principles as guidelines for decision-making, documentation, investigation, and settlement procedures. This improves consistency and efficiency in claims administration. By preventing fraudulent claims, excessive compensation, and duplicate recoveries, insurance principles protect insurers from financial instability. This contributes to the long-term sustainability of insurance companies. Clear application of insurance principles helps resolve claims disputes and supports legal compliance. Moreover, insurers can justify settlement decisions based on established insurance doctrines and contractual obligations. The principles of insurance play a fundamental role in claims management by guiding the investigation, assessment, validation, and settlement of claims. Principles such as utmost good faith, insurable interest, indemnity, subrogation, contribution, proximate cause, and loss minimization provide the legal and operational framework for efficient claims administration. These principles help insurers determine liability, prevent fraud, ensure fairness, control costs, recover losses, and maintain financial stability. They also protect policyholders by ensuring that genuine claims are handled professionally and consistently. Effective application of insurance principles is therefore essential for successful claims management, customer satisfaction, regulatory compliance, and the long-term credibility of the insurance industry. Challenges in insurance claims settlement. The challenges in insurance claims settlement include: 1. Fraudulent claims. Fraudulent claims increase claims costs and create operational difficulties. Insurers implement investigation and fraud detection systems to protect against abuse. 2. Delayed documentation. Incomplete documentation may delay investigations and settlement. 3. Policy interpretation disputes. Ambiguous policy terms may create disagreements regarding coverage or exclusions. 4. Underinsurance. Where the sum insured is lower than the actual value of the property, claims settlement may be reduced under the average clause. 5. Legal and regulatory issues. Claims disputes may result in litigation or regulatory intervention. 6. Economic inflation. Inflation increases repair and replacement costs, affecting claims reserves and settlement adequacy. Types of insurance claims management. Claims management is a multifaceted function that involves various approaches to prevent losses, investigate claims, assess damages, settle liabilities, and protect the insurer's financial stability. Effective claims management is essential for maintaining customer trust, controlling insurance costs, ensuring regulatory compliance, and supporting the long-term sustainability of insurance companies. The major types of claims management include pre-loss and post-loss management, reactive and proactive management, centralized and decentralized systems, manual and digital claims management, and specialized, technical claims administration. Each type of claims management serves specific operational objectives within the insurance industry. Modern insurers increasingly integrate technology, risk management, fraud prevention, and customer service into claims operations to improve efficiency and competitiveness. Pre-loss claims management. Pre-loss claims management refers to all activities undertaken before insured losses occur. It involves proactive measures designed to reduce the frequency, severity, and financial impact of future claims. The objective of pre-loss management is not merely to settle claims after losses occur, but to prevent or minimize them in the first place. Insurance companies increasingly recognize that effective loss prevention improves profitability and reduces operational pressure on claims departments. Pre-loss claims management is closely connected to underwriting, risk management, safety engineering, and loss prevention functions. Here are the various forms of pre-loss claims management. 1. Risk identification and risk assessment. One of the major components of pre-loss claims management is the identification and assessment of risks before policy issuance. Insurers conduct inspections, surveys, and risk evaluations to understand the nature of hazards associated with proposed insurance risks. The findings help insurers determine appropriate premium rates, policy conditions, warranties, deductibles, and coverage limits. For example, before insuring a manufacturing factory, insurers may inspect fire protection systems, electrical installations, storage facilities, and occupational safety measures. Proper risk assessment reduces the likelihood of large future claims. 2. Loss prevention and risk control. Loss prevention forms a major aspect of pre-loss management. Insurers provide recommendations aimed at reducing the probability of losses occurring. These measures may include installing fire extinguishers, burglar alarms, surveillance systems, and sprinkler systems, as well as protective clothing, safety training, and emergency response procedures. In engineering and industrial insurance, insurers may recommend regular equipment maintenance and compliance with safety regulations. The implementation of effective risk control measures reduces claims frequency and improves underwriting profitability. 3. Policy design and coverage structuring. Insurance companies manage claims proactively through proper policy design. Policy wordings are carefully drafted to define the scope of coverage, exclusions, warranties, conditions, deductibles, and limitations. Well-structured insurance policies reduce ambiguity and minimize disputes during claims settlement. Underwriters and claims managers often collaborate during policy development to ensure that policy terms are clear, enforceable, and aligned with risk exposure. 4. Fraud prevention systems. Pre-loss claims management includes fraud prevention mechanisms designed to detect suspicious risks before claims arise. Insurance companies conduct background checks, verify customer information, analyze previous claims history, and assess behavioral patterns before accepting risks. Modern insurers also use data analytics, artificial intelligence, and centralized databases to identify high-risk applicants or potential fraud indicators. Effective fraud prevention reduces future claims losses and protects insurer profitability. 5. Customer education and risk awareness. Insurance companies educate policyholders on policy conditions, claims procedures, safety requirements, and risk management responsibilities. Customer awareness reduces misunderstandings and encourages compliance with policy obligations. For example, motor insurers may educate drivers on accident reporting procedures, while fire insurers may provide guidance on fire safety practices. Well-informed policyholders are less likely to engage in negligent behavior that may result in avoidable losses. 6. Catastrophe planning and emergency preparedness. Insurers develop catastrophe management plans to prepare for large-scale disasters such as floods, earthquakes, explosions, pandemics, or civil unrest. Emergency preparedness involves establishing claims response teams, disaster communication systems, reserve arrangements, reinsurance support, and mobile claims units. Pre-loss catastrophe planning enables insurers to respond efficiently when large volumes of claims arise simultaneously. Post-loss claims management. Post-loss claims management encompasses all activities undertaken after insured losses occur. It involves investigating, assessing, processing, negotiating, and settling policyholder claims. The primary objective of post-loss claims management is to ensure that valid claims are settled promptly and fairly while protecting the insurer against fraudulent or exaggerated claims. Post-loss management represents the practical execution of the insurance contract. Here are the common forms of post-loss claims management. 1. Claims notification and reporting. Post-loss management begins when the insured notifies the insurer of a loss. Most insurance policies require prompt notification of losses. Claims notifications may be made through branch offices, online portals, mobile applications, email, telephone calls, brokers or agents. The notification process captures important details such as the date of loss, cause of loss, location, extent of damage, and circumstances surrounding the incident. Prompt reporting enables insurers to commence investigations quickly and minimize further losses. 2. Claims registration and file creation. After notification, the insurer officially registers the claim and creates a claims file. The claims file contains all relevant information regarding the claim, including policy documents, claim forms, correspondence, investigation reports, photographs, invoices, repair estimates, and settlement records. Proper documentation and record keeping are essential for efficient claims administration and legal compliance. 3. Claims investigation. Investigation is one of the most important aspects of post-loss claims management. Insurance companies investigate claims to verify their authenticity, determine liability, and assess the extent of damages. Claims investigations may involve site inspections, interviews, forensic analysis, police reports, witness statements, medical examinations, engineering assessments, and review of supporting documentation. The complexity of investigations varies depending on the nature and size of the claim. Simple claims may require minimal verification, while large industrial losses may involve extensive technical investigations by specialists. 4. Claims assessment and loss evaluation. Claims assessment involves determining the financial value of losses suffered by the insured. Claims adjusters, surveyors, engineers, valuers, accountants, and medical experts may participate in evaluating losses depending on the insurance class involved. Assessment considers factors such as depreciation, replacement cost, market value, salvage value, policy excesses, coverage limits, and underinsurance. The purpose is to ensure that the settlement reflects the insured's actual financial loss in accordance with the policy terms. 5. Claims negotiation. In many claims situations, negotiations occur between insurers and claimants regarding settlement amounts. Negotiation becomes necessary when disagreements arise concerning liability, the extent of damages, policy interpretation, or valuation methods. Claims managers use negotiation skills to achieve fair settlements while protecting insurer interests. Successful negotiation reduces litigation costs and improves customer relationships. 6. Claims settlement. Claims settlement represents the final stage of post-loss management. Once liability is confirmed and assessment completed, the insurer authorizes payment or other forms of compensation. Settlement may occur through cash payment, repair, replacement, reinstatement, or provision of services, depending on policy terms. Claims settlement aims to restore the insured to the financial position they occupied before the loss, without allowing a profit from the insurance. Prompt settlement improves customer satisfaction and strengthens the insurer's reputation. 7. Recovery and subrogation. After settling claims, insurers may pursue recovery from responsible third parties through subrogation rights. Recovery management helps insurers reduce net claims costs and improve financial performance. For example, after compensating a motor policyholder for accident damages caused by another driver, the insurer may recover the amount paid from the negligent party. Effective recovery management requires legal expertise, documentation, and coordination with external parties. Reactive claims management. Reactive claims management focuses primarily on responding to claims after losses occur rather than preventing losses beforehand. This traditional approach emphasizes investigation, settlement, and dispute resolution after insured events have already happened. Reactive management is common in conventional insurance systems where claims departments operate separately from underwriting and risk management functions. Reactive claims management is often characterized by extensive documentation requirements, detailed investigations, legal reviews, and claims adjustment processes. The approach may result in delayed settlement if insurers focus excessively on procedural verification rather than customer experience. Although reactive management remains important for fraud prevention and liability assessment, modern insurers increasingly combine it with proactive strategies. Proactive claims management. Proactive claims management involves anticipating, preventing, and minimizing losses before they occur while also ensuring efficient settlement after losses happen. This approach integrates claims management with risk management, underwriting, customer education, and technology systems. Proactive claims management focuses on long-term loss reduction rather than merely processing claims. Proactive management reduces claims frequency, improves customer satisfaction, enhances operational efficiency, and lowers overall claims costs. Insurers adopting proactive approaches often use predictive analytics, artificial intelligence, risk engineering, telematics, and behavioral monitoring to identify high-risk situations before losses occur. This approach has become increasingly important in modern insurance operations. Centralized claims management. Centralized claims management occurs when claims handling activities are controlled from a single central office or headquarters. All claims processing, approvals, investigations, and settlement decisions are coordinated centrally. Centralized management promotes consistency in claims handling standards and decision-making processes. It improves supervision, fraud control, quality assurance, and regulatory compliance. Large insurers often use centralized systems supported by digital platforms and specialized claims teams. However, centralization may sometimes reduce flexibility and slow response times, especially in geographically dispersed regions. Likewise, policyholders in remote areas may experience communication difficulties if local claims presence is limited. Decentralized claims management. Decentralized claims management allows regional offices, branches, or local claims units to handle claims independently within approved authority limits. This system provides greater operational flexibility and faster local response. Decentralized systems improve customer accessibility, speed of claims reporting, and local decision-making. Claims officers familiar with local conditions may better understand regional risks and customer needs. However, decentralized systems may create inconsistencies in claims handling practices when proper supervision is lacking. Likewise, fraud control and standardization may become more difficult across multiple locations. Manual claims management. Manual claims management relies primarily on paper documentation, physical files, face-to-face communication, and traditional administrative procedures. This method was widely used before the advancement of digital technology. However, manual systems are often slower, less efficient, and more vulnerable to human error, document loss, and fraud. Furthermore, claims processing may involve lengthy paperwork and delayed communication. Hence, many insurers are gradually replacing manual systems with digital alternatives. Digital claims management. Digital claims management involves using technology to automate and streamline claims handling processes. Insurers use electronic claims platforms, mobile applications, artificial intelligence, cloud computing, and data analytics to improve efficiency. Digital systems allow online claims notification, electronic document submission, automated workflows, real-time tracking, fraud analytics, and instant communication with policyholders. Artificial intelligence may also assist in claims triaging, image analysis, and predictive fraud detection. Digital claims management improves speed, accuracy, transparency, customer experience, and operational efficiency. It also reduces administrative costs and enhances data security. Modern insurance companies increasingly rely on digital systems to remain competitive in the evolving insurance market. Specialized claims management. Certain insurance classes require specialized, technical expertise during claims handling. Engineering, aviation, marine, oil and gas, cyber insurance, and medical malpractice claims often involve highly technical investigations and assessments. Specialized claims management may require the involvement of engineers, medical professionals, aviation experts, forensic investigators, accountants, and legal consultants. Catastrophe claims management. Catastrophe claims management focuses on handling large volumes of claims arising from natural disasters or major emergencies. During catastrophic events, insurers establish special disaster response teams, mobile claims centers, emergency communication systems, and expedited settlement procedures. Efficient catastrophe management is essential for maintaining public confidence and operational continuity. Insurance claims process. The insurance claims process refers to the systematic procedures followed by insurance companies in receiving, investigating, assessing, processing, and settling claims arising from insured events. It is the operational mechanism through which insurers fulfill their contractual obligations to policyholders or beneficiaries after losses occur. The claims process is one of the most critical aspects of insurance operations because it directly affects customer satisfaction, insurer reputation, financial stability, and regulatory compliance. Efficient claims handling demonstrates the insurer's reliability and strengthens public confidence in the insurance industry. Although the fundamental objective of claims management is similar across all insurance classes, the procedures differ significantly between life and non-life insurance due to the nature of the risks covered, methods of benefit determination, contract durations, and the complexity of investigations. Life insurance claims generally involve the payment of fixed contractual benefits arising from death, survival, maturity, disability, or policy surrender. Non-life insurance claims, on the other hand, involve indemnification for financial losses resulting from events such as fire, accidents, theft, liability, engineering failures, or natural disasters. Understanding the distinction between life and non-life insurance claims processes is essential for insurance professionals, policyholders, brokers, and risk managers. An insurance claim is a formal request by a policyholder or beneficiary to an insurance company for compensation or policy benefits following an insured event. The insurer evaluates the claim against policy terms, insurance principles, documentation, investigations, and legal requirements before deciding whether to accept or reject it. Claims may arise under life insurance, health insurance, motor insurance, fire insurance, marine insurance, aviation insurance, liability insurance, engineering insurance, and other classes of insurance business. Objectives of the insurance claims process. 1. Fulfillment of contractual obligations. The primary objective of the claims process is to fulfill the insurer's contractual promise under the insurance policy. Insurance companies are obligated to compensate policyholders or beneficiaries for valid insured losses. 2. Protection against fraud. Claims procedures help insurers detect fraudulent, exaggerated, or invalid claims through investigations, documentation checks, and verification processes. 3. Customer satisfaction. Efficient claims settlement improves customer confidence, strengthens insurer reputation, and enhances policyholder retention. 4. Financial control. Claims management helps insurers control claims costs, maintain profitability, and ensure proper reserve management. 5. Regulatory compliance. Insurance companies must comply with legal and regulatory requirements governing claims administration, consumer protection, and fair settlement practices. Non-life insurance claims process. Non-life insurance claims arise under general insurance contracts covering risks such as motor accidents, fire damage, theft, marine losses, engineering breakdowns, aviation incidents, liability exposures, and business interruption. Most non-life insurance contracts operate on the principle of indemnity, meaning that compensation aims to restore the insured to the same financial position before the loss, without allowing a profit from the insurance. Non-life claims are usually short-term in nature and often involve detailed technical investigations. Stages in the non-life insurance claims process. Here are the stages involved in the non-life insurance claims process. 1. Notification of loss. The non-life claims process begins when the insured notifies the insurer of a loss. Insurance policies usually require prompt notification after an incident occurs. Notification may be made through branch offices, brokers, online portals, mobile applications, emails, or telephone calls. The notification includes details such as the date of loss, the cause of the damage, the location of the incident, the nature of the affected property, the estimated loss amount, and the circumstances surrounding the event. Prompt notification allows insurers to commence investigations quickly and prevent further losses. 2. Completion of claims forms. After receiving notification, the insurer provides the insured with claims forms to complete. The claims form captures essential information related to the incident, including policy details, a description of the loss, witness information, references to police reports, repair estimates, and the claimant's declarations. The accuracy and completeness of claims forms significantly affect claims processing efficiency. 3. Submission of supporting documents. The insured submits documents required to support the claim. The nature of required documents depends on the class of insurance involved. Motor insurance claims may require police reports, driver's licenses, repair estimates, vehicle particulars, and photographs. Fire insurance claims may require fire service reports, inventories of damaged property, invoices, and repair quotations. Marine insurance claims may involve bills of lading, invoices, survey reports, and shipping documents. Liability insurance claims may require court documents, medical reports, and witness statements. However, adequate documentation enables insurers to properly verify losses and assess liability. 4. Claims registration and file opening. The insurer officially registers the claim and opens a claims file containing all documents, reports, correspondence, and records related to it. Claims files serve as official records for investigation, assessment, settlement, auditing, and legal purposes. 5. Claims investigation. Claims investigation is one of the most important stages in non-life claims management. The insurer investigates the circumstances surrounding the loss to confirm policy coverage, determine proximate cause, verify the extent of damages, and detect possible fraud. Investigations may involve site inspections, interviews, forensic analysis, police reports, engineering assessments, and expert consultations. Claims adjusters, surveyors, engineers, medical practitioners, or forensic specialists may participate depending on the complexity of the claim. 6. Appointment of loss adjusters and surveyors. For large or technical claims, insurers may appoint independent loss adjusters or surveyors to assess damages and provide professional reports. The adjusters evaluate the extent of loss, estimate repair or replacement costs, assess salvage value, determine policy liability, and recommend settlement amounts. Loss adjusters usually prepare preliminary and final reports to guide the insurer's settlement decision. 7. Determination of liability. The insurer determines whether the claim falls within policy coverage. This involves examining policy conditions, exclusions, warranties, endorsements, premium payment status, and applicable insurance principles. The insurer also determines whether the proximate cause of loss is covered under the policy. If the claim violates policy conditions or arises from excluded events, liability may be denied. 8. Assessment and quantification of loss. Claims assessment involves determining the financial value of the damages suffered. The insurer considers factors such as depreciation, market value, replacement cost, salvage value, deductibles, underinsurance, and policy limits. In liability claims, assessment may involve legal damages, compensation awards, and settlement negotiations. Business interruption claims may require a financial analysis of profit losses and increased operating costs. 9. Claims negotiation. Where disagreements exist regarding liability or settlement amounts, negotiations may occur between the insurer and the insured. Negotiation aims to achieve a fair settlement while protecting insurer interests and maintaining customer relationships. 10. Claims settlement. Once liability is confirmed and the assessment is complete, the insurer settles the claim in accordance with the policy terms. Settlement may occur through cash payment, repair, replacement, reinstatement, or provision of services. The insured may be required to sign discharge vouchers acknowledging receipt of compensation. 11. Recovery and subrogation. After settlement, the insurer may pursue recovery from negligent third parties responsible for the loss. Subrogation rights allow the insurer to recover claims payments from liable parties. Recovery management helps reduce net claims costs and improves insurer profitability. Features of non-life insurance claims process. Here are the features of the non-life insurance claims process. 1. Indemnity-based settlement. Most non-life claims are settled based on the insured's actual financial losses. 2. Technical investigation. Non-life claims often require engineering, forensic, legal, or technical investigations. 3. Short-term contracts. Most non-life insurance policies operate on annual renewal contracts. 4. Variable claims amounts. The value of claims varies depending on the extent of losses incurred. 5. Higher fraud exposure. Non-life insurance claims are generally more vulnerable to fraud and exaggerated losses. Life insurance claims process. Life insurance claims arise when insurers are obligated to pay benefits upon death, survival, maturity, disability, surrender, or other policy events covered by life insurance contracts. Unlike non-life insurance, life insurance is generally not based on indemnity. The insurer pays the agreed sum assured and any applicable bonuses in accordance with the policy terms. Life insurance claims often involve long-term contracts and fixed benefit payments. Types of life insurance claims. 1. Death claims. Death claims arise upon the death of the insured person. 2. Maturity claims. Maturity claims occur when endowment policies reach the maturity date. 3. Survival benefit claims. Certain life insurance products provide periodic survival benefits during the policy term. 4. Surrender claims. Surrender claims arise when policyholders terminate policies before maturity and receive surrender values. 5. Disability claims. Some life policies provide benefits for permanent disability or critical illness. Life insurance claims process. Here are the stages in the life insurance claims process. 1. Notification of death or claim event. The claims process begins when beneficiaries, policyholders, employers, or their representatives notify the insurer of a death or other insured event. Notification includes submitting basic information, such as the policy number, date of death, cause of death, and claimant details. 2. Submission of claims forms and documents. Claimants complete claims forms and submit supporting documents. Required documents may include death certificates, medical reports, hospital records, identification documents, policy documents, police reports, probate documents, and beneficiary information. For maturity claims, policyholders may submit policy documents and identification records. 3. Verification of policy status. The insurer verifies whether the policy was active at the time of the insured event. The insurer confirms premium payment status, policy duration, coverage conditions, nominations, assignments, and beneficiaries. Policies that lapsed before the occurrence of death may not qualify for benefits unless reinstatement conditions apply. 4. Investigation of cause of death or claim event. The insurer investigates the circumstances surrounding the claim to verify authenticity and prevent fraud. Investigations may focus on medical history, cause of death, non-disclosure of material facts, occupation, lifestyle habits, and criminal activities. Early claims occurring shortly after policy inception often attract more detailed investigations. 5. Non-disclosure and moral hazard checks. Life insurers examine whether the insured disclosed all material facts during policy inception. Material non-disclosure relating to health conditions, smoking habits, dangerous occupations, or previous illnesses may affect claim settlement. The insurer also investigates moral hazards such as fraudulent death claims, forged documents, or deliberate concealment of information. 6. Determination of beneficiaries and legal entitlement. The insurer identifies persons legally entitled to receive policy proceeds. Where nominations exist, benefits are paid to nominated beneficiaries. Where no nomination exists, insurers may require probate or letters of administration before settlement. 7. Benefit calculation. The insurer calculates the policy benefits payable in accordance with the policy terms. The calculation may include the sum assured, accrued bonuses, survival benefits, cash value, outstanding policy loans, and interest adjustments. Unlike non-life insurance, life insurance benefits are generally predetermined rather than based on actual financial loss. 8. Claims approval and settlement. After verification and approval, the insurer pays benefits to beneficiaries or policyholders. Settlement is usually made through bank transfers, checks, annuity arrangements, or direct payments to financial institutions in mortgage protection policies. 9. Reinsurance recovery. Where life insurers have reinsurance arrangements, they may recover portions of large claims from reinsurers after settlement. Reinsurance improves insurer capacity and financial stability. Features of life insurance claims process. Here are the features of the life insurance claims process. 1. Fixed benefit payments. Life insurance claims involve payment of predetermined sums assured rather than indemnity-based compensation. 2. Long-term contracts. Life insurance policies are usually long-term contracts extending over several years. 3. Extensive non-disclosure checks. Life claims investigations focus heavily on medical disclosure and moral hazards. 4. Legal documentation requirements. Life claims often require probate documents, beneficiary verification, and estate administration procedures. 5. Lower frequency but higher severity. Life claims occur less frequently but may involve substantial financial liabilities. Major differences between life and non-life insurance claims processes. The difference between life and non-life insurance claims processes includes: 1. Nature of compensation. Non-life insurance claims are based on indemnity and actual financial loss suffered, while life insurance claims involve payment of predetermined contractual benefits. 2. Nature of risks covered. Non-life insurance covers property damage, liability, accidents, theft, and business losses, while life insurance covers death, survival, disability, and maturity risks. 3. Claims investigation focus. Non-life claims investigations focus on the cause and extent of physical losses, whereas life claims investigations emphasize medical history, non-disclosure, and beneficiary entitlement. 4. Policy duration. Non-life insurance policies are generally short-term annual contracts, while life insurance contracts are long-term agreements. 5. Documentation requirements. Non-life claims require technical documents such as repair estimates and survey reports, while life claims require death certificates, medical records, and probate documents. 6. Settlement basis. Non-life claims vary according to actual losses incurred, while life claims are usually based on fixed policy benefits. 7. Fraud exposure. Non-life insurance faces higher exposure to staged accidents, inflated damages, and property fraud, while life insurance fraud often involves concealment of medical information or false death claims. The insurance claims process is a structured system through which insurers fulfill contractual obligations after insured events occur. Effective claims management ensures fair settlement, fraud prevention, operational efficiency, customer satisfaction, and financial stability. Although life and non-life insurance claims processes share common stages such as notification, documentation, investigation, assessment, and settlement, they differ significantly in terms of compensation methods, investigative focus, legal requirements, and policy structures. Non-life insurance claims primarily involve indemnification for actual financial losses arising from accidents, fire, theft, liability, and property damage. Life insurance claims, on the other hand, involve the payment of predetermined contractual benefits related to death, maturity, disability, survival, or policy surrender. Efficient management of both life and non-life insurance claims is essential for maintaining public trust, protecting insurer solvency, ensuring regulatory compliance, and supporting the long-term sustainability of the insurance industry. Claims documentation by the insured and the insurer. Claims documentation is one of the most important components of insurance claims management. It involves the collection, submission, verification, recording, and preservation of documents relating to insurance claims. Proper documentation enables insurers to investigate claims, determine liability, assess losses, prevent fraud, and ensure fair settlement. Insurance claims cannot be processed effectively without adequate supporting documents. Documentation serves as evidence of the policy's existence, the occurrence of loss, ownership of the insured property, the extent of damages, and compliance with policy conditions. Both the insured and the insurer play significant roles in generating and maintaining claims documents throughout the claims process. The quality, accuracy, and completeness of claims documentation greatly influence the speed and outcome of claims settlement. Inadequate documentation may delay settlement, create disputes, increase operational costs, or lead to repudiation of claims. Claims documentation is therefore essential for operational efficiency, legal compliance, financial accountability, fraud prevention, and customer satisfaction within insurance operations. Claims documentation refers to all written, electronic, photographic, legal, financial, medical, technical, and administrative records used during the processing and settlement of insurance claims. These documents provide evidence supporting the validity, cause, extent, ownership, and value of losses claimed under insurance policies. Claims documentation includes records prepared by both the insured and the insurer during the claims management process. Importance of claims documentation. The importance of claims documentation includes: 1. Verification of claims. Documentation helps insurers verify whether losses actually occurred and whether the claim falls within policy coverage. Claims documents provide factual evidence required for claims investigation and liability determination. 2. Prevention of fraud. Proper documentation helps insurers identify fraudulent, exaggerated, or duplicate claims. Insurers use documents to cross-check information provided by claimants and detect inconsistencies or suspicious activities. 3. Facilitation of claims assessment. Claims documentation enables accurate valuation of losses. Documents such as invoices, repair estimates, medical reports, and valuation certificates assist insurers in determining compensation amounts. 4. Legal and regulatory compliance. Insurance companies are legally required to maintain proper records of claims transactions. Claims documentation supports regulatory reporting, auditing, litigation management, and dispute resolution. 5. Improvement of operational efficiency. Well-organized documentation improves claims processing speed and enhances communication between insurers, claimants, brokers, adjusters, and other stakeholders. 6. Customer protection. Proper documentation protects the interests of policyholders by ensuring transparency and fairness during claims settlement. Claims documentation by the insured. The insured is responsible for providing documents necessary to support the claim. Insurance contracts impose obligations on policyholders to furnish accurate and complete information regarding losses suffered. The insured must cooperate fully with insurers during claims investigations and provide all relevant documents within reasonable timeframes. Failure to provide adequate documentation may delay settlement or result in the denial of claims. Types of documents submitted by the insured. The insured may be required to submit several documents depending on the type and nature of the insurance claims. Document to be submitted by the insured may include 1. Claims notification letter. The claims process usually begins with the insured's notification of loss. Prompt notification is a condition precedent to the insurance company's acceptance of liability. The notification letter or communication informs the insurer of an insured event and provides preliminary details of the loss. The notice may include the policy number, date and time of the loss, nature of the loss, location of the incident, estimated damages, and contact information. 2. Completed claims form. The insurer provides a claims form that the insured must complete. The claims form contains detailed information about the loss and serves as the formal basis for investigating and processing claims. The form typically includes the policy details, a description of the incident, the circumstances surrounding the loss, witness information, the estimated value of the damages, and a declaration by the claimant. Accurate completion of claims forms is critical for efficient claims management. 3. Proof of ownership documents. The insured must provide evidence showing ownership or insurable interest in the damaged or lost property. Proof of ownership helps insurers verify entitlement to compensation. Such documents may include the purchase receipts, invoices, title documents, vehicle registration papers, certificates of ownership, lease agreements, and mortgage documents. 4. Police reports. Police reports are commonly required in cases involving theft, burglary, robbery, motor accidents, malicious damage, assault, or suspicious circumstances. The police report provides independent verification of the incident, and may contain witness statements, accident details, and preliminary findings. Insurers rely on police reports during fraud investigations and liability assessments. 5. Medical reports and hospital records. Medical documentation is essential in health insurance, personal accident insurance, liability claims, and life insurance claims. Medical records help insurers confirm injuries, illnesses, disabilities, or causes of death. These documents may include medical reports, hospital records, doctor's certificates, laboratory test results, death certificates, and autopsy reports. 6. Repair estimates and invoices. In property and motor insurance claims, the insured may submit repair quotations, invoices, or replacement estimates prepared by mechanics, contractors, engineers, or suppliers. These documents assist insurers in assessing the cost of repairs or replacements. 7. Photographs and video evidence. Photographs and video recordings provide visual evidence of damage and help insurers assess the extent of losses. Visual evidence strengthens the credibility of claims and supports investigations. Digital evidence has become increasingly important in modern claims management systems. Photographs may show accident scenes, fire damage, flood impact, vehicle damage, injuries sustained, and property destruction. 8. Witness statements. Witness statements may be required where independent testimony is necessary to establish the circumstances surrounding losses. Witness accounts help insurers reconstruct incidents and verify claims. Witnesses may include neighbors, passengers, employees, security personnel, passers-by, and bystanders. 9. Fire service reports. Fire insurance claims often require reports issued by fire service authorities. This document supports fire claims investigations. The report may contain details on the cause of the fire, the extent of damage, the time of the incident, firefighting efforts, and preliminary observations. 10. Marine and cargo documents. These documents help establish cargo ownership, shipment conditions, and the extent of marine losses. Marine insurance claims require specialized shipping and cargo documents such as the bill of lading, shipping invoices, packing lists, survey reports, port authority reports, and protest letters. 11. Financial records. Financial records help quantify economic losses suffered by businesses. Business interruption claims and financial loss claims may require accounting and financial documents, including profit and loss statements, balance sheets, tax records, sales records, payroll documents, and inventory records. 12. Death certificates. Insurers rely heavily on death certificates during life claims processing. Life insurance claims require official death certificates issued by authorized government authorities. The death certificate confirms the identity of the deceased, the date, cause, and place of death. 13. Probate and letters of administration. They establish legal entitlement to receive policy proceeds. Where beneficiaries are not directly nominated, insurers may require legal documents authorizing the administration of the estate. These documents include the grant of probate, letters of administration, and court orders. Claims documentation by the insurer. Insurance companies generate and maintain extensive records throughout the claims management process. Insurer documentation supports investigation, assessment, reserving, settlement, auditing, recovery, litigation, and regulatory reporting. Claims files maintained by insurers form official records of claims transactions. Types of documents prepared by the insurer. 1. Claims acknowledgement letter. After receiving notification of loss, the insurer issues an acknowledgement letter confirming receipt of the claim. This communication formally initiates claims processing. The acknowledgement may include the claim reference number, required documents, the claims officer's contact details, and claims procedure guidelines. 2. Claims file. The insurer opens a claims file containing all documents relating to the claim. Claims files serve as central records throughout the claims process. The claims file may include the policy documents, correspondence, investigation reports, photographs, medical records, settlement records, and legal documents. 3. Investigation reports. Claims investigators prepare reports based on findings from inspections, interviews, and evidence analysis. These reports support claims decision-making. Investigation reports may address the cause of loss, the circumstances surrounding the incident, indicators of fraud, liability assessment, policy compliance, and recommendations. 4. Loss adjusters reports. Independent loss adjusters may be appointed to assess complex or large claims. These reports contain technical evaluations, damage assessments, repair estimates, salvage details, and settlement recommendations. Adjusters usually prepare preliminary, interim, and final reports. 5. Survey reports. Surveyors may inspect damaged property, cargo, machinery, or engineering equipment and prepare technical reports regarding the extent and cause of damage. Survey reports are common in marine, engineering, aviation, and industrial insurance claims. 6. Internal claims assessment reports. Claims officers prepare internal reports evaluating policy coverage, liability, reserve adequacy, settlement recommendations, and management approvals. These reports assist supervisors and management during decision-making. 7. Reserve records. Insurers maintain claims reserve records, showing estimated liabilities for outstanding claims. Reserve documentation supports financial reporting and solvency management. Types of reserve records include outstanding claims reserves, incurred but not reported, IBNR, reserves, and catastrophe reserves. 8. Claims correspondence. Insurers maintain records of all communications relating to claims. Claims correspondence provides evidence of interactions between parties during claims processing. Correspondence may involve emails, letters, telephone records, SMS notifications, and legal notices. 9. Settlement vouchers and discharge forms. Once claims are approved, insurers prepare settlement vouchers and discharge forms. The discharge form confirms that the claimant accepts the settlement amount as full settlement of the claim. Settlement documents may include the amount payable, deductibles applied, salvage details, payment instructions, and claimant signatures. 10. Payment records. Insurers maintain records of claims payments made to claimants, service providers, hospitals, repairers, or beneficiaries. Payment records support auditing, accounting, and financial control functions. 11. Legal documentation. Legal documentation supports dispute resolution and compliance. Claims involving disputes or litigation generate legal documents, including court filings, legal opinions, settlement agreements, arbitration records, and judgments. 12. Recovery and subrogation records. Recovery documentation helps insurers reduce claims costs. Where insurers pursue recovery from third parties, they maintain documentation relating to recovery demands, legal actions, settlement negotiations, salvage disposal, and reinsurance recoveries. Electronic claims documentation. This promotes the digitalization of claims records. Modern insurance companies increasingly use electronic documentation systems to improve efficiency and data security. Digital systems reduce paperwork, improve accessibility, and accelerate claims processing. Digital claims documentation includes online claims forms, electronic signatures, cloud storage, digital photographs, electronic payment systems, and automated workflows. Electronic documentation improves claims processing speed, record accuracy, data retrieval efficiency, fraud detection capabilities, customer communication, and operational cost management. Digital systems also support remote claims administration and real-time monitoring. Challenges in claims documentation. The challenges of claims documentation include: 1. Incomplete documentation. Claims processing may be delayed where claimants fail to provide all required documents. Incomplete records complicate investigations and liability assessments. 2. Fraudulent documents. Some claimants submit forged invoices, fake receipts, manipulated photographs, or falsified medical records. Insurers, therefore, conduct extensive verification procedures. 3. Delayed submission of documents. Late submission of documents may affect investigation quality and delay settlement. Some policies specify strict timelines for documentation submission. 4. Poor record management. Improper storage or loss of records may create operational inefficiencies and legal complications. Insurers must maintain secure and up-to-date documentation systems. 5. Data protection risks. Claims documentation often contains sensitive personal and financial information. Insurers must ensure confidentiality, cybersecurity, and compliance with data protection regulations. Importance of accurate documentation in claims settlement. 1. Facilitation of fair settlement. Accurate documentation enables insurers to settle claims fairly and consistently. 2. Reduction of disputes. Proper records reduce misunderstandings and support transparent claims decisions. 3. Improvement of fraud detection. Well-documented claims are easier to verify and audit. 4. Enhancement of customer satisfaction. Efficient documentation procedures accelerate settlement and improve customer experience. 5. Support for legal defense. Claims documentation provides evidence during litigation or regulatory investigations. Claims documentation is a fundamental component of insurance claims management. Both the insured and the insurer play essential roles in generating, submitting, verifying, and maintaining documents required for claims processing and settlement. The insured provides evidence supporting the occurrence, ownership, and extent of losses, while the insurer generates investigation reports, assessment records, settlement documents, reserve records, and legal documentation. Proper claims documentation promotes transparency, operational efficiency, fraud prevention, regulatory compliance, financial accountability, and customer satisfaction. Inadequate or inaccurate documentation may delay settlement, increase disputes, and expose insurers to financial and legal risks. As insurance operations continue to evolve, digital documentation systems, electronic claims processing, and advanced data management technologies are increasingly transforming claims administration and improving the efficiency of modern insurance companies. Customer service in claims management. Customer service in claims management entails professional support, communication, guidance, and assistance provided to claimants throughout the claims handling process. It involves ensuring that claimants receive timely information, fair treatment, prompt responses, and efficient settlement of valid claims. Customer service extends beyond claims payment to include emotional support, transparency, professionalism, accessibility, and effective communication throughout all stages of claims administration. It includes how insurance companies interact with policyholders, beneficiaries, claimants, brokers, and other stakeholders throughout the claims handling process. It involves communication, responsiveness, empathy, professionalism, transparency, and efficiency in managing insurance claims from notification to settlement. Claims management is often described as the moment of truth in insurance because it is the stage at which policyholders expect insurers to fulfill the contractual promises made at policy inception. While underwriting and marketing attract customers, effective claims service determines whether customers remain loyal to the insurer. A policyholder who experiences a loss is often under financial, emotional, or psychological stress. Consequently, the quality of customer service during claims handling significantly influences customers' perceptions, satisfaction, trust, and long-term relationships with the insurance company. Excellent customer service in claims management enhances insurer reputation, improves customer retention, reduces disputes, strengthens regulatory compliance, and contributes to operational efficiency. Poor customer service, however, may result in complaints, litigation, reputational damage, and loss of business. Customer service has therefore become a strategic component of modern insurance claims administration. The importance of customer service in claims management. The importance of customer service in claims management includes: 1. Fulfillment of the insurance promise. Insurance policies represent promises of financial protection against unforeseen losses. Claims management is the stage where insurers demonstrate whether they can fulfill those promises effectively. Excellent customer service reassures policyholders that the insurer is dependable and trustworthy. 2. Enhancement of customer satisfaction. Prompt and professional claims service improves customer satisfaction. Policyholders are more likely to remain loyal to insurers that handle claims efficiently and compassionately. Claims handling often influences customers more strongly than premium rates or marketing campaigns. 3. Improvement of insurer reputation. Insurance companies build reputations based largely on their claims service performance. Efficient customer service strengthens public confidence in insurance institutions and improves market competitiveness. Insurers known for poor claims service may experience reputational damage and reduced customer retention. 4. Reduction of complaints and disputes. Transparent communication and fair treatment help reduce misunderstandings and conflicts between insurers and claimants. Good customer service minimizes complaints, litigation, and regulatory sanctions arising from claims disputes. 5. Promotion of operational efficiency. Effective customer service systems improve communication flow, documentation handling, claims tracking, and response times. This contributes to faster claims settlement and better operational performance. 6. Compliance with regulatory standards. Insurance regulators often require insurers to maintain fair claims practices and effective customer complaint resolution systems. Customer service standards, therefore, support regulatory compliance and consumer protection objectives. Objectives of customer service in claims management. 1. Prompt assistance to claimants. One major objective of customer service is to provide immediate assistance to policyholders after losses occur. Claimants require guidance regarding claims procedures, documentation requirements, policy coverage, and settlement expectations. 2. Fair and transparent treatment. Customer service aims to ensure fairness, honesty, and transparency during claims handling. Policyholders should clearly understand the basis of claims decisions and settlement calculations. 3. Emotional support during loss situations. Many insurance claims arise during stressful situations involving accidents, injuries, illnesses, fires, deaths, theft, or business disruptions. Customer service personnel must therefore demonstrate empathy and emotional sensitivity when interacting with claimants. 4. Efficient claims resolution. Customer service seeks to minimize delays and improve settlement speed while maintaining accuracy and compliance. Efficient claims resolution enhances customer confidence and operational effectiveness. Components of customer service in claims management. The components of customer service in claims management include: 1. Effective communication. Communication is one of the most important components of customer service in claims management. Insurers must maintain clear, timely, accurate, and consistent communication with claimants throughout the claims process. Poor communication often creates frustration, confusion, and distrust among policyholders. Claimants should receive updates on claim status, required documentation, investigation progress, settlement decisions, payment timelines, and reasons for any delays or repudiation. 2. Accessibility and availability. Insurance companies must ensure that customers can easily access claims services when needed. Easy access to claims support improves customer experience and operational convenience. Accessibility may include the insurer's branch offices, telephone support, online claims portals, mobile applications, email communication, social media support, and customer care centers. 3. Empathy and compassion. Claims situations often involve emotional distress, financial hardship, injury, or bereavement. Claims officers and customer service personnel must show empathy, patience, and understanding during interactions with claimants. Compassionate treatment reassures customers and improves relationships between insurers and policyholders. 4. Professionalism. Professionalism involves ethical conduct, competence, courtesy, integrity, and accountability in handling claims. Claims personnel should possess the technical knowledge, communication skills, and emotional intelligence necessary for effective customer interactions. Professional behavior enhances insurer credibility and trustworthiness. 5. Transparency. Transparency requires insurers to communicate openly and honestly regarding policy terms, coverage limitations, claims procedures, and settlement calculations. Transparent communication reduces disputes and promotes trust. Customers should clearly understand: 1. What is covered. 2. What is excluded. 3. Why are certain decisions made. And 4. How are settlement amounts determined. 6. Responsiveness. Responsiveness refers to the speed and efficiency with which insurers address customer inquiries, complaints, and claim notifications. Prompt responses improve customer confidence and reduce frustration during stressful situations. Delayed communication is one of the most common causes of dissatisfaction in insurance claims management. 7. Fairness in claims handling. Fair treatment is essential in claims administration. Claims should be evaluated objectively in accordance with policy terms, insurance principles, and applicable laws, without discrimination or bias. Fair claims handling strengthens customer confidence and supports ethical business practices. 8. Confidentiality and data protection. Claims management involves handling sensitive personal, financial, medical, and legal information. Customer service requires insurers to maintain strict confidentiality and protect customer data from unauthorized access or misuse. Compliance with data protection laws is essential in modern insurance operations. It is essential to highlight customer service at different stages of insurance claims management. Customer service at different stages of claims management. 1. Customer service during claims notification. The first interaction between the insurer and claimant often occurs during claims notification. The quality of this initial interaction significantly influences customer perception. At this stage, customer service personnel should respond promptly, provide reassurance, explain the claims procedures, inform claimants of the required documents, and guide customers on the next steps. 2. Customer service during claims investigation. Claims investigations may create anxiety among claimants, especially when delays occur. Insurers should maintain regular communication regarding the progress of investigations and expected timelines. Claims officers should explain why certain documents or inspections are necessary. Transparency during investigations reduces suspicion and frustration. 3. Customer service during claims assessment. During loss assessment, claimants may disagree with valuation methods, or settlement estimates. Customer service personnel should explain assessment procedures clearly and professionally. Where necessary, insurers may engage in negotiations while maintaining fairness and respect. 4. Customer service during claims settlement. Settlement is the most critical stage in customer experience. Prompt payment, accurate documentation, and clear communication enhance customer satisfaction. Where claims are partially paid or repudiated, insurers should provide detailed explanations supported by policy provisions. Professional handling of settlement decisions reduces disputes and complaints. 5. Customer service after claims settlement. Post-settlement communication is also important. Insurers may seek customer feedback regarding claims experiences and identify areas for improvement. Good post-settlement service strengthens long-term customer relationships and promotes retention. Customer complaints handling in claims management. Claims complaints handling consists of procedures used by insurers to resolve dissatisfaction arising from claims processing or settlement decisions. Complaints may involve delayed claim settlement, poor communication, disputed valuation, claim repudiation, unprofessional conduct, and administrative errors. Effective complaint handling protects the insurer's reputation and improves customer confidence. It also helps insurers identify operational weaknesses and improve service quality. Prompt and fair complaint resolution is essential for maintaining customer trust. Insurance companies often establish complaint resolution systems that include customer service units, internal review processes, escalation procedures, ombudsman services, and regulatory complaint mechanisms. Technological advancements help insurance firms improve customer service in claims management through 1. Digital claims platforms. Technology has significantly transformed customer service in insurance claims management. Digital systems improve convenience and response times. Modern insurers use digital platforms that allow customers to report claims online, upload documents electronically, track claim status, receive automated notifications, and communicate with claims officers remotely. 2. Artificial intelligence and automation. Artificial intelligence supports customer service through chatbots, automated claims triaging, virtual assistants, predictive analytics, and fraud detection systems. Automation improves efficiency and enables faster customer responses. 3. Mobile applications. Many insurers now provide mobile applications that enable policyholders to submit claims, upload photographs, receive updates, and communicate directly with claims teams. Mobile technology enhances accessibility and customer convenience. 4. Social media and customer engagement. Insurance companies increasingly use social media platforms for customer engagement and claims communication. Social media channels support the rapid dissemination of information during emergencies or catastrophic situations. Challenges of customer service in claims management. Here are the core challenges of customer service in insurance claims management. 1. Delays in claims processing. Claims delays remain one of the major causes of customer dissatisfaction. Delays may result from incomplete documentation, complex investigations, system failures, or administrative inefficiencies. 2. Fraudulent claims. Fraud investigations sometimes create tension between insurers and genuine claimants. Balancing fraud prevention with customer satisfaction can be challenging. 3. Poor communication. Inadequate communication often leads to misunderstandings, distrust, and complaints. Customers become frustrated when they do not receive timely updates regarding claim progress. 4. High customer expectations. Modern customers expect rapid responses, digital convenience, transparency, and personalized service. Insurers may struggle to meet these expectations during periods of high claims volumes. 5. Catastrophic events. Natural disasters and large-scale emergencies may overwhelm claims departments and affect service quality. Insurers must prepare catastrophe response systems to maintain customer support during crises. 6. Technological challenges. While digital systems improve efficiency, technical failures, cybersecurity threats, and system outages may disrupt customer service operations. Best practices in customer service for claims management. Here are the best practices in customer service for claims management. 1. Prompt claims acknowledgement. Insurers should acknowledge claims immediately after notification. Early communication reassures customers and establishes confidence. 2. Clear communication. Claims procedures, timelines, documentation requirements, and settlement decisions should be communicated clearly and transparently. 3. Continuous customer updates. Regular progress updates reduce uncertainty and improve customer trust. 4. Employee training and development. Claims personnel should receive training in communication skills, emotional intelligence, technical claims handling, conflict resolution, and customer relationship management. 5. Use of technology. Digital claims systems improve speed, accessibility, and convenience for customers. 6. Fair and consistent claims decisions. Claims decisions should be objective, transparent, and based on policy provisions. Consistency promotes trust and reduces disputes. 7. Customer feedback systems. Insurers should collect customer feedback to evaluate service quality and identify improvement areas. Role of claims personnel in customer service. 1. Claims officers. Claims officers interact directly with customers and coordinate claims processing activities. They play major roles in communication, documentation review, investigation coordination, and settlement discussions. 2. Customer service representatives. Customer service representatives provide guidance, respond to inquiries, handle complaints, and assist claimants during the claims process. 3. Claims managers. Claims managers supervise claims operations, ensure service quality, resolve escalated complaints, and maintain operational standards. Impact of good customer service on insurance companies. The impact of good customer service on insurance companies includes: 1. Increased customer retention. Satisfied customers are more likely to renew policies and maintain long-term relationships with insurers. 2. Enhanced market reputation. Strong claims service improves public perception and competitive positioning. 3. Higher profitability. Good customer service reduces disputes, litigation costs, and customer turnover. 4. Improved operational efficiency. Efficient communication and claims handling reduce administrative delays and improve workflow management. Customer service is a vital component of insurance claims management. It involves providing professional, empathetic, transparent, responsive, and efficient support to policyholders and claimants throughout the claims handling process. Effective customer service enhances customer satisfaction, strengthens insurer reputation, improves operational efficiency, reduces disputes, and supports regulatory compliance. It also demonstrates the insurer's commitment to fulfilling contractual obligations fairly and responsibly. Modern insurance companies increasingly combine skilled claims personnel, digital technologies, effective communication systems, and customer-focused strategies to improve claims experiences. As competition within the insurance industry intensifies, customer service in claims management remains a critical factor in determining customer loyalty, market reputation, and long-term business success. Conclusion? This video has examined the components and practices of insurance claims management. Insurance claims management is a critical function within the insurance industry because it represents the practical fulfillment of the insurer's promise to policyholders and beneficiaries. Regardless of how effective underwriting, marketing, or product development may be, the true value of insurance is ultimately measured by the insurer's ability to handle claims fairly, professionally, and efficiently. Throughout this discussion, it is evident that claims management is far more than simply paying compensation after losses occur. It is a comprehensive process involving legal principles, contractual obligations, technical investigations, financial assessments, customer service, fraud prevention, regulatory compliance, and operational coordination. Let us highlight the key takeaways of the video. Key takeaways. 1. Insurance claims management represents the core promise of insurance. The claims function is the practical demonstration of the insurer's commitment to compensate policyholders for insured losses. Efficient claims settlement is essential for maintaining trust and credibility within the insurance industry. 2. The insurance contract governs claims settlement. Claims are settled strictly in accordance with the terms and conditions of the insurance contract. Policy conditions, exclusions, warranties, endorsements, and coverage limits determine insurer liability. 3. Insurance principles guide claims management. Principles such as utmost good faith, indemnity, insurable interest, proximate cause, contribution, and subrogation influence claims investigations, liability determination, compensation, and recovery processes. 4. Claims management includes both pre-loss and post-loss activities. Pre-loss management focuses on risk prevention, underwriting, safety measures and fraud prevention, while post-loss management involves notification, investigation, assessment, settlement, and recovery. 5. Non-life and life insurance claims processes differ significantly. Non-life claims are generally indemnity-based and require technical investigations, while life insurance claims involve fixed contractual benefits, beneficiary verification, and legal documentation. 6. Proper claims documentation is essential. Accurate and complete documentation supports claims verification, fraud prevention, legal compliance, and fair settlement. Both the insured and the insurer have important documentation responsibilities. 7. Claims investigation protects both insurers and policyholders. Investigations help verify losses, determine liability, assess damages, and detect fraudulent claims. Effective investigations improve settlement accuracy and financial control. 8. Customer service is critical in claims management. Prompt communication, empathy, transparency, professionalism, and responsiveness improve customer satisfaction and strengthen the insurer's reputation during claims handling. 9. Technology is transforming claims management. Digital platforms, automation, artificial intelligence, and data analytics are improving claims processing efficiency, fraud detection, customer experience, and operational performance. 10. Fraud prevention remains a major priority. Fraudulent claims increase insurance costs and threaten insurer profitability. Strong investigation systems, data analytics, and verification procedures are necessary to combat fraud. 11. Effective claims management supports financial stability. Efficient claims handling protects insurer solvency, enhances operational efficiency, supports regulatory compliance, and contributes to the long-term sustainability of insurance companies. I hope this video is educational and beneficial to you. Please post your comments below in the comments section. If this video has been educational and beneficial, please give it a thumbs up and share it with your friends. Thank you for seeing the Solomon Fadun, Risk Management of Everything videos. I love hearing from you. Please post your comments and questions below in the comments section. If you are new here, subscribe to the channel, Solomon Fadun, Risk Management of Everything's channel, and click the notification button to be notified when new videos are uploaded. Thank you.